Hello, it's Melissa with Atlas CFO. Today is going to be short. I am talking about my favorite ratios. This just seems maybe a little nerdy, but I do love some ratios. I do love some scorecards. So the first question we're going to talk about is, why do we even bother with this? It can be extra work in our firms. It can be sometimes confusing for people. But the reason why I like them is because they are either leading, lagging indicators, or they're triggers. Now, my favorites are, of course, the leading indicators or the triggers. We'll talk about them just a little bit. A leading indicator gives us an idea of what's coming at us. A lagging indicator is something in the past, but it can give real support to something that we are thinking is happening in our business, and our lagging indicators can say, yes, that's true. And our triggers are, if this happens, we will take action. Triggers can be really important in a business. If you find that one of your indicators is saying, hey, we maybe need to watch out for cash or revenue or backlog, we then can take action to make our business successful. I had someone recently tell me that the reason why we spend time on scorecards and ratios is because we want to drive with our headlights on, not drive with the rearview mirror. I thought this was a great way to describe why we spend so much of our time looking forward, doing forecasting, doing projections, doing leading indicators, and then teaching you the way to make sure that your business is set up for those. I thought it was a great description, and I wanted to pass it along. Without further ado, my favorites. My first favorite is current ratio. Now, I might actually pick working capital, but working capital doesn't fall in the ratio world as much, so you get current ratio, which is the same thing. How to calculate current ratio is you take current assets divided by current liabilities. To do this, you'll need your balance sheet and those two categories off of the balance sheet to calculate it. My favorite number to pick is about 1.6. If your minimum is 1.2, that's about as low as I want to go. So 1.2 is the bare minimum. 1.6 is what I like to see. My second ratio is debt to equity. To calculate debt to equity, you'll take your balance sheet again, and you will take your total liabilities divided by your total equity section. Again, I'm giving you my numbers that I use, but you can certainly use other resources to get them. I like to see 3 or under for debt to equity. That tells me that there is room in the organization to take on additional debt if they have to. And my last one, which is my favorite, is backlog. I like to take backlog revenue divided by goal revenue. So what's goal revenue? Goal revenue could be your break-even revenue, or it could be your target revenue. You'll take your total backlog that you have at any given time divided by the revenue that you're shooting for. I like to see at least 30%. When I see a minimum of 30%, it tells me that the business is going to be able to sustain that revenue in the future. If I see below 30%, I've usually found that the company really struggles to get to that goal revenue. I am keeping it short today. So if you want more scorecard information, please visit our website at atlascfo.com, and you can get our free scorecard and some videos on how to use it. Thank you. Hope to see you soon.